Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And today we're going to be going back to an indicator that we haven't taken a look at in over a year, and yet it's one that's based on another very popular indicator. A lot of you have probably heard of the volume-weighted average price, known as the VWAP. Today we're going to be talking about a variation on that indicator that's used more for the longer term charts, or at least not just intraday. It's known as the anchored VWAPs. Let me know if you're familiar with that indicator, but we're going to be discussing how it's built, how it might be used for structuring trades, actually placing a new trade using that indicator. A lot to cover. But before we get into that discussion, let me first of all say hello to everybody who's joining. Hello out there on YouTube. Great to see Bill and Grace, Tokyo, Greg, Marcus, Andy, Jim, Lola, Scott, Ricebird, Crispy, David, everybody else. Thanks for joining us week after week. We really always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, we'll enjoy the presentation. But be aware that you're invited to join us in the live discussion. This is a Friday webcast series. We kick things off promptly every Friday, 1 Eastern time. We would love to have you here in that live stream audience. And as a treat for my live stream audience members right now, we have my very good friend Mike Fairborn, who's hanging out in the chats with us. Mike and I go way back. We've worked together now for about 20 years, Mike, right? But in any case, thanks for having my back there, Mike. If you have an account with X, speaking of Mike, you should be following all of your favorite presenters there. So follow me, follow Mike there. You can find Mike on X at Mike Fairborn CS. You can find me there at Cameron May CS, but it's the very best place to connect with your presenters when the cameras aren't on. But let's get into this discussion of the anchored VWAP. And as we do, of course, there are going to be risks associated with this approach, just as there are with pretty much any approach that carries a reward potential. So please do bear these important disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. All investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right. So with that accomplished, let's lay out the agenda for today's discussion. First thing that we're going to do is we're going to take a quick peek at our two current trades in our example paper money portfolio, one of which I think we need to wrap up today. We'll talk about that in just a moment. But after we're done with that, we're going to move over to the S&P 500, see what's going on with the stock market. We're going to look at it through that trend, value, momentum, strategy set lens. And then we're going to get to our discussion of the anchored VWAP. I do think this is going to be new to a lot of you. It's not something I've discussed in quite a while in this webcast series. So I want to make sure that I go at a pace that everybody can follow. But we're going to talk about how it's built, how it might be used to generate entry signals, where exit signals may occur, or how target and stop orders might be planned using the indicator. And then we're going to plan and place an example trade before we're done. So a lot of territory to cover. Let's start covering it. Scott says, I've seen other traders use it effectively. You haven't tried to work on it. Okay. Well, Scott, I'll try to help you along that learning curve as much as I can. Let's go to the Thinkorswim platform. Right now, we have two example trades. We have AMD and we have Kroger. So AMD is doing well and has done well for us previously. Kroger not doing so well. So let's look at AMD first, since it shows up first here. In any case, previously, we took a trade on AMD on a technical signal that just involved an upward sloping 9-day exponential moving average. And instead of using traditional candles here, we're using Heikin Ashi candles. But when we started to see those bullish Heikin Ashi candles show up, and especially those strongly bullish Heikin Ashi candles, that's when we took the initial trade with a stop $2 below recent lows. And eventually we were stopped out. It's actually a pretty strong day here. We placed at $2 below that recent low. We had a strong day down, stopped out for a 16.39 profit, about 11.2% earned on that trade. So that one worked out. This one we'll still see. But we took a new entry as that 9-day exponential moving average started turning back up again. We had Heikin Ashi's rising bullishly again. New entry right there on the 8th of August. Now, we didn't have time at that moment to place a stop. So I think what we're going to do is introduce that stop. Let's put it 2% below. For right now, we'll go below this recent low. It's also coinciding with that moving average. So just for simplicity's sake, it looks like that moving average is at 176.08. That's interesting. I think that's what we paid for our stock, something like that. But 176.08, we'll go $2 below that, be consistent with the original trade management technique. Let's place our stop at 174.08, 2% below that moving average. So we're going to go to our monitor tab. Quick way to place a stop on an existing position is just right-click on that position, create a closing order with that stop. Okay, that'll take us to our trade tab. It has the correct quantity. It just doesn't know where we want that stop. And we decided here, let's go 174.08. Make that order good till canceled. Let's confirm and send that. We're going to sell if AMD happens to fall down to or below 174.08. As with other types of stops, with stop orders, there's no guarantee the execution price will be equal to or even near the activation price, in this case, the 174.08. So let's send that order off. Now, I realize that some of you weren't here to see that original discussion of the exponential moving average used in combination with Heikin Ashi's. That's why I always like to throw out reminders each week that these webcasts are recorded and then posted to our Trader Talks YouTube channel. So if you haven't subscribed to the channel yet, do yourself a favor and click on the subscribe button right now. Down in the lower right-hand corner, you can click on that subscribe. It only takes a second, doesn't cost anything, but our Trader Talks channel is where we house those previous webcasts. So the full channel name, if you want to look it up on YouTube, is Trader Talks Schwab Coaching Webcasts. And you can go to the playlist right here. And this webcast series, right down the middle, we have a bunch of webcast series, but right down toward the middle, you'll find advanced charting techniques. I can click on view full playlist. That'll give me all the previous discussions, including building a short-term trade system with Heikin Ashi candles, which is how we built this one. Princess Investing says, can you please show how to sell covered calls? It's a good question, but this webcast series is not dedicated to options trading. We do have lots of options-oriented webcasts, including covered calls. So, as a matter of fact, I actually teach a webcast that's called Covered Calls and Short Puts. It's every Monday. So if you have that sort of an interest, you can go to our channel and just go to the playlists, or even you could just do a search. Let me just type in the word covered. Don't even need to type in the whole thing. Type in covered and you're going to find trading covered calls and short puts. There's my playlist. You can just click on view full playlist. And there you have it. Okay. So hopefully that'll help you out there, Princess Investing. But back to our positions here. We now have a stop. It's waiting at just 2% below. So this is a short-term approach to trading, this one that was demonstrated. So using tighter stops is a common approach. Now, it's always up to each trader to determine if or where they're going to place their stops. That's the stop we're using for today. Going on to our next trade, we have Kroger. This is last week's trade. So to revisit that, let's go to the charts. Let's type in KR, and we saved it. Well, first of all, this wasn't built using Heikin Ashi candles. So let's change our chart type from Heikin Ashi back to just a traditional candle. Then we'll go to our studies and load up our Kroger DMI crossover. So here was our signal, our DMI crossover. We noted that positive DMI crossed up above negative DMI, generating what's known as a bullish crossover, and we're looking to sell if we got a bearish crossover. Guess what we got a couple of days ago when class was not in session? Yep, there's the signal. That was our plan. Let's execute the plan. Let's go to the monitor tab and close out that Kroger position. Create a closing order. Let's sell that thing. I'm going to actually sell this at the current market price. Now, well, not at the current market price, but with a market order, quite different. Placing a market order is not a guarantee that we're going to sell at the displayed price. It may be different. But let me click confirm and send. We're going to sell the 70 shares at the market price. There's not a commission on this trade. There wasn't a commission on the AMD position at the time we placed it. There can be commissions on certain types of trades. Now, With market orders, as I just mentioned, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. So we will probably fill somewhere around 69.58, but we don't know for sure if and until that order does fill. So let's click send. We just sold at 69.56. Yep, so price changed a little bit. So that position is now flattened. 69.56 means we took a little bit of a haircut, maybe less, probably less than $1. Yeah, but a loss was incurred. That's one of the risks when trading stocks, even when we think we've done a lot of homework to pick just the right technical set of indicators. Nothing's a guarantee of performance, but in any case, we're done with that trade. Now, some of you might be saying, Cameron, why did you get out? My analysis, you might look at this chart and say, aren't we right at a support area? Well, that wasn't the plan for this trade. So if a trader has made a decision at the front end of a trade when they will be exiting a trade, there's a temptation to revisit that decision when that exit date arrives. And that may be a little bit of the thing is that can undermine the trader's success potentially in the long term, because making decisions on the fly is a very difficult to repeat process in an effective way over the long term. So I'm sticking with the plan on this one. So that one's done. Let's get to the markets. What's going on with the S&P 500? A little bit of a fade today, down 1/5 of 1%. Okay, Kevin says, Cam, you kept referencing the stop being not 2% below. Sorry, I meant to say $2. Did I say 2%? If I did, it was a misstatement. It was $2 in both cases. So what was the full question here, Kevin? You kept referencing the stop being 2% below current price for AMD, yet you ended the stop order with stop loss only $2 lower than the current price. Yeah, exactly. Yep. If I verbalize 2%, believe me, in my head, I was saying $2, which is what the original stop was. So yeah, good. Thank you for catching that. Every once in a while, I can misspeak when I'm trying to talk and do at the same time. Yep. Okay. Anyway, let's switch up our set of technical indicators. Now, one thing that we do that is consistent from week to week is we use the same set of technical studies to take a look at the S&P 500. I don't want that to come across as this being the ultimate set of technical studies. It's just an example of how a trader might want to introduce some consistency from one trade decision to the next. So we're being consistent that way. Let's go up to our studies, and we're going to load up our TVM strategy set. So this is known as our trend value momentum strategy set, consisting of 3 indications, not 3 indicators. There are actually 4, but 3 indications: one for trend, one for value, one for momentum. Now, the trend indication happens to be generated by a combination of 2 indicators. If you weren't here to see the logic of this setup, you can just go to the channel. It's going to be a little bit further down. You're going to have to scroll down. It's been some time back, so I'm going to have to scroll, and so I'm sort of scanning as I go. But it's going to be understanding the trend value momentum. Where is it? I went too far. Anyway, you'll be able to find it probably faster than I do, as I'm trying to do it quickly in a live setting. Anyway, wherever it found itself, you can find it. Oh yeah, it was probably back here before Mike. No. Anyway, yeah. Another quick way that we can find it, of course, is to just do a search. TVM, understanding the trend value momentum chart trading system. So if you watch that archive, it'll explain this in greater detail than I'm going to go into today. But basically, this is used when a trader is looking for a confirmation in sort of an intermediate to longer term of what the trend of a stock or an index is. And that, in this case, is going to be a combination of a 50 period triangular moving average against a 100 period triangular moving average. These are also known as double smooth moving averages. But if our faster, which is our green one here, that's our 50, if that's rising above the slower or the 100, for a trader here, that might be a confirmation of bullish technical strength. Now, any combination of technical variables isn't a guarantee that if it's seen as being strong right now, it doesn't mean that it's certainly going to be stronger in the future. But yeah, this to me, through that lens, would be a bullish confirmation, looking bullish. Now, within an intact upward trend, there can be periods of weakness where prices may be reached extremes and may be more likely to turn down than to continue going back up. And that's where our value and momentum indicators might come into play a role. So our value indicator is our RSI. RSI isn't always expressly used for identifying value, but for our short-term traders, sometimes they'll look to see is the stock in a period where it's currently overbought or oversold within its trend, whatever that trend might be. And right now, that RSI is pretty high, starting to tip over just a little bit. So we'll see. Net, that's still probably bullish, but if this does go down a little bit further, what might that take the appearance of? For those of you who use RSI, there might be some traders who are noting that the most recent high was higher than this one. We might be getting a bit of a bearish divergence that might be causing even a bullish trader who might see a strong trend to hit the pause button before aggressively taking new positions. That's one way that might be interpreted. So let's just say at this moment, maybe still cautiously bullish. Now, finally, we have our momentum oscillator, and we're using the MACD for that purpose here. And momentum is just a gauge of, do the buyers seem to be having primary control at the moment, or do the sellers seem to be driving prices at the moment? And so with a typical MACD interpretation, we'd be looking at a low and rising MACD as being a sign of strengthening bullish momentum, a high and falling MACD as weakening momentum. So right now, it looks like most recently it's shifted from bearish to moving toward bullish and just crossed over the zero line. That's continued bullishness. So overall, it's kind of 2 votes for bullish, 1 vote for cautiously bullish, possibly tilting bearish. So for some traders, that may cause them to adapt their approach. Maybe they'd be more aggressive if we're bullish, maybe a little bit more conservative on potential entries if we're mostly bullish, but a little bit bearish. There we go. Anyway, that's our trend value momentum combination of indicators. That's going to set the stage for today's discussion. We are going to still be placing a bullish trade example today. I really do just limit myself to that. I try to keep it stock investing, to keep it the focus on technical indicators as much as possible. So let's first of all, let's move to our example stock first. So I'm going to use for our first example, let's look at CDNS. I'm getting away from, I've been trading a lot of those stocks that are among the very largest in the S&P 500. And what I'm doing is I'm moving my hands like this. I'm visualizing my S&P 500 watch list, which is organized from largest companies to smallest companies within the S&P 500. And it's that top group that I've done a lot of demonstrations there. I'll probably do that again toward the end of today, but let's go a little bit further down that list of S&P 500 companies. Here's Cadence Design Systems. And I'm going to switch up my drawing set. I'm going to come up here. Let's remove all the current studies from that TVM set. It's actually not deleting the TVM set. It's just removing it from this chart. And then we're going to add this anchored VWAP. So let me come up here. I'm going to click on Edit Studies. I'm going to type in the word anchored. And you'll see anchored VWAP is the only study with the word anchored in it. So it sorts right through all those. I'm going to add that to our chart, click Apply, and click OK. And there's our indicator. So what does this immediately look like? I know some of you are going to go, hey, wait a minute. This looks just like something else. It's not exactly the same. Doesn't it look a whole lot like Bollinger Bands? That's because it's a sort of a cousin to the Bollinger Bands. But it's also related closely to just the traditional VWAP volume weighted average price. So this indicator consists of three lines. We have a type of a moving average running through the center, and then we have an upper band and a lower band. And just like with Bollinger Bands, the upper band and the lower band are two standard deviation lines moving above and below the center line. But instead of the center line being a true moving average, like a simple moving average, which would be common for a Bollinger Band, this is actually a VWAP line. So we need to talk about how this is constructed. But let me first of all summarize what are the upper and the lower bands. If you don't know what two standard deviations are, I can't fault you, because it's been a long time since I studied standard deviations in a formal educational setting. Yeah, that was back in college for me, which was now approaching 30 years ago. Anyway, but these lines, the way that I might describe this is if I were given an assignment to look at this chart, figure out where the average is, and then draw a line around, draw an envelope around that average that encompasses 95% of the trading activity for that chart, that's about where I draw that line. You'll notice this goes above most of the tops for the year. It also drops down below most of the bottoms for the year, but there are certainly some areas where price gets outside of this range. If we look at this as a range of prices sometimes escape outside of that. That's because this is two standard deviations, which in math is just figure out the center point of a data set and then capture 95% of the variations from that center point. That's what that is. Okay, so those are our lines, but I want to talk more about how this purple line is generated. And it's generated through a five-step process. Let's come over here to our scratch pad, and I want to outline those steps. And I wrote these down, tried to gather my thoughts before the webcast started, so I could do this as clearly but as also as quickly as possible. Step number one in generating this purple line, this volume weighted average price line, is to determine something known as the average price. Okay? And the average price is simply the high of a candle plus the low of a candle plus the close divided by 3. I mean, if I were to give you an assignment, notice that our indicator is actually anchored. It starts by default on the first candle of whatever chart we're using. You'll notice that our lines converge there on that very first candle, and then they fan out from there. So if I were to give you an assignment, look at that first candle and say, hey, what was the average price on that day? You might say, well, average, how do I determine average on a whole bunch of prices? That I don't want to add them all up and divide by however many trades there were that day. So maybe what I might do is look at the high price and the low price and maybe the close price, add those three together as sort of a stand-in for the whole day's activity, divide that by 3, and that gives me an average. That'll work. That's exactly how this is built. And as we learned last week when we were talking about DMI, sometimes we don't call that an average price. We call that a typical price. Same thing. Okay. Journey says, did you say anchored VWAP? Were you discussing when to change the anchor? Absolutely did, and absolutely will be. Yep. Yeah. Good question. But this average price is the starting point for the calculation of our anchored VWAP. Then we move on to step number 2, which is we take that average price and multiply it by the volume for that candle. And this produces something known as the PV. Now, I've looked into this. I don't know exactly what the PV stands for. To me, I've always thought of this as sort of the period value, because this indicator is attempting to use price and volume to assign a value to both of those things at once. So if we have a stock that's moving up sharply on heavy volume, that can have a large positive value. If we have a stock that's moving down sharply on heavy volume, that can have a large negative value. But you might think of that as the period or the day's value. Does that make sense? I don't know exactly what the PV stands for, but that's what I think of it as being. But in any case, then we move on to step number 3, which is to take that PV and divide it by the total volume since we started calculating this. So each day we calculate a new PV and we divide it by the volume for all the days, all of the periods since we started the indicator. Number 4 is to just continue doing that. You calculate a new PV, and then we add the new PV to the trailing or the previous PV, or PV. And divide that by the total volume since we started this whole calculation. So that, I would say in a nutshell, that's kind of a big nutshell though, right? But that's the equation that generates our volume weighted average price. The bottom line though, if you followed that, that's great. If you didn't follow the equation, that's okay too. Basically, we're trying to assign volume and price a value and then show that on a chart on a line to see that tug of war between high volume up days and high volume down days. There we go. So Hope says, isn't PV just price times volume? It's the average price times volume. So yeah. Okay. So in any case, that's how this is generated. Let's talk about how it might be used. So what we're doing here is we're getting this weighted average line, weighted by price and volume, and observing its change over time. And then what the trader is looking for is how the price itself is behaving relative to that line. Now, sometimes price can drift quite a ways from that VWAP line. And in a traditional VWAP, traditionally VWAP on an intraday basis, and even on a multi-day basis, on an extended time frame like this, it can be used by institutions in the management of their funds where they're attempting to move funds without having a huge impact on price. Just to put yourself in the shoes of a large portfolio manager. Maybe you have tens of thousands of shares that you need to distribute into the marketplace, but try to do that. You're trying to sell your shares without driving the price down at the same time, because if we're selling at the same price at the same time when everybody else is selling, we could drive the average price down further and further and further, and our orders are filling at worse and worse levels, and it's not good for that large trader. So what they may look for in their efforts to not influence price too far away from that average is they may try to execute sell orders when we're a little bit above average, execute buy orders a little bit below average. So they're really just sort of nudging things toward average. That's the concept. I've never actually managed large funds like that. So what goes behind those closed doors, I can't offer direct insight, but that's the theory of this indicator that I've heard discussed before. Great. We'll let that sit there. But in any case, for other traders of this indicator, what they might look for are extreme departures from the average as measured by our purple VWAP line as opportunities for maybe entering at lows, potentially at extreme lows, and then using the VWAP line itself possibly for exits. So here's what I'm talking about. When we get a strong move down below our VWAP line, that can mean that price has been driven down by strong volume relative to other volume days. Anyway, when we get down to that second standard deviation line, to some traders, that is the definition of an extreme scenario where prices are unusually low. And they may see that as possibly an entry opportunity. So a common entry signal for those who use an anchored VWAP is to look for when prices get down close to that lower band, at 2 standard deviations below average as measured by our VWAP. And when they start to see white candles, meaning intraday strength, that may be an entry. So I do see a white candle right here, small white candle, but still white, right there on October 24th. That's a potential entry. There were other ones right through here. There's another cluster of them right here, another cluster of those. Well, there's actually a white candle right there where we're right close to or touching that lower band. So that is a traditional entry. where might exits be taken? Well, another assumption for traders using this indicator is that there is likely to be a reversion to the mean, meaning prices have gotten away from average. Maybe they'll make their way back toward that average. So in this case, prices, the assumption for the trader is that we bought at this extreme low. Maybe this will snap back to average, and their plan may be to get out once we've risen back up to this price or better. So let's see, Chris, did a question come in about my exponential moving average? So I don't have an exponential moving average on here right now, so it must be referring to something else. Okay, yeah, you're going back to the Heikin Ashi. Okay, yeah, I'll let you. Let's see, maybe Mike. I don't know if you saw that question. Anyway, in this case, the trader might have gotten in here with a plan to exit here, but there was a gap up overnight. Maybe they filled at or near the next day's open up here. In this case, it might have required a bit more patience because price didn't immediately start to rally. And even when it did rally, we missed that target and fell back down again, rallied again, ultimately finally hit that target here. So this trade might have taken some patience, whether we entered here, here, or we had the more fortunate timing to get in right there. But that's a pretty typical round trip using the anchored VWAP. Now, a second way to enter these sorts of trades is on just this sort of an event when we start to cross over, just like a traditional moving average crossover. As price crosses up and through that VWAP line, the trader may use that as an entry if they weren't already in and taking profits here. Maybe if they see us blasting up and through that on a strong white candle, they may take an entry here with the plan to exit at or possibly near, depending on the trader's preferences, but targeting the upper band. In this case, it looks like it came up just shy. Back here, we got just a touch. So maybe on this crossover, actually, they touched it well before that. In any case, yeah, that would be a typical trade exit there. And in this case, it fell back down. I will say there wasn't otherwise an exit here. So maybe our trader ultimately got their target right there. But those are two common bullish approaches to trading with anchored VWAP. Now, a difficulty with anchored VWAP, let's see, Scott says, sorry if I missed this, but is it possible to use the different time ranges for anchoring the VWAP? Yes, absolutely. Scott, it's a good question. It's exactly what I'm moving to right now. Greg says for a short-term time frame, use VWAP line as a guide. Now, if we were to go to intraday, that would typically be the territory of the VWAP. The anchored VWAP is commonly used when we get outside of just the intraday charts and we're looking at longer-term charts. By longer term, I mean anything longer than intraday. All right. But yes, here's an observation that some have already made. They've asked questions about. The anchored VWAP, its real value is in the fact that it can be anchored to something other than just the start of the chart. But we have to know when might the trader decide to move the anchor point, and where might they decide to move it to? Well, I'll summarize that. Basically, the trader would typically look for big reversal points. So, for example, when a stock has been moving sharply in one direction and it starts to reverse and head the opposite direction, so we've had a pretty good reversal point, actually right there. That is a common signal to our trader to move their VWAP. Let's do that. Let me just clean up these drawings. Right-click, clear the drawing set. Now, on Thinkorswim, it's actually really easy to move the anchor point. So right now, we're anchored at the start of the chart. Let's say that our trader looked over here and decided to adjust that anchor by right-clicking and setting the new date to whatever date we've chosen as the reversal point. Now, I want you to let me before I do that, let's be explicit here. A reversal point is when price has been going one direction and then it makes a strong move in a new direction. I have to say, it would be nice if we happened to know on April 4th that that was going to be the reversal point. We don't know that until sometime after it has reversed. So typically, after price has started to move up or moving in a new direction after having gone down, the trader might reach a point where they recognize, oh, this is actually reversed in a significant way. It's time to move my anchor. So then they might right-click on that reversal date and set the new anchor right there. And from here, trade just using the same signals. So either a bounce off our VWAP line. Actually, I forgot to mention that. That's it. Sometimes I've said it in my head and I haven't. Yeah, bounces off the lower band or one signal. Actually bounces off the VWAP, our second signal, and then the third signal is the crossover that we talked about. But in any case, here we had price get well above our VWAP line, and then it's dropped back down below, or brought back down to the VWAP, and started to bounce again. We're starting to see white candles at or near that VWAP line. If we take an entry here, where's the exit? Just as with the crossover, we'd typically be looking for an exit at or near the upper band. So Scott, you like how that, you like the date adjustment example there? Now there's another signal that some traders will take. If they struggle to spot when to move their VWAP line, if they have one that's already in place, one signal that might be useful is if we start to get substantially outside our bands, it might be time to move the anchor point. So here we'll see the price got well above that upper band. So the trader might take that as their cue. If I haven't moved my anchor point recently, maybe I need to look back to the most recent reversal. And here it looks like probably the strongest recent reversal was right there. So I'm going to right click on that and set that as my new date. There we go. And then we can maybe trade using that. All right. But let me just make sure. I'm going to go through my notes. Oh, yeah. I always have notes that keep me on track. Let me set this back. Let's come back to the original anchor point. Let's set that date back here. And we've talked about taking profits, which is always the fun part of the discussion. But there's definitely always the possibility that a trade, no matter how well one has planned the trade, there's definitely always the possibility that the trade might fail. So let's say we're getting in on one of these bounces, or possibly one of these breakouts, a subsequent bounce, any one of those. Where might the trader just say, oops, this one isn't working out? Well, typically, if we're getting in because price appears to be bouncing off one of those bands, if it instead turns right around and pierces back down through that band, trade is over. But there's some proportionality that's commonly recruited here. If we're getting in at this lower band as an example, and the VWAP line is 2 standard deviations away, well, maybe that trader's okay with risking, let's say, half of a standard deviation in the wrong direction, just in case their timing isn't perfect. Now, so if price starts to get half a standard deviation down below this lower band, maybe they get out. Now, they could use a dollar amount, they could use a percentage amount, but if they're sticking with a more, let's say, consistent technical approach, maybe they also use standard deviations. So here's a way that might be employed quickly. Okay, I'm going to add a second anchored VWAP. Let's go up here to our edit studies. Let's type in anchored VWAP and add another one to our chart. But this one, instead of identifying the possible entries, is going to be used to draw lines for possible exits. So I'm going to tailor this one. Here's how that might be done. Let's come over to the little gear icon. First one, I'm going to put that one not at -2. That's 2 standard deviations below the VWAP. Let's put it at -0.05. Oops, no, 0.5. There we go. that extraneous point. There we are. So this is going to draw a line just a half a standard deviation below our VWAP line. Now, at the same time, I'm going to put another one in. Let's put this one in at minus 2.5. I'm going to make both of these, the upper, which is this, and the lower, which is this, make those red. And actually, just make them nice and clearly distinct from the other ones. Let's make them dashed. There we go. But as we click OK and we click Apply, you'll see what the purpose might be for those. What this allows the trader to see very quickly is, let's say we get a breakout and we think price is going to go up, but if it comes down, if it gets more than 1/2 of one standard deviation below our AVWAP, maybe that signal isn't working, and maybe the trader takes their losses at that point. Or if we're taking an entry on the lower band, if it goes in the wrong direction, maybe we take our losses there. And you can see how there were several examples where price continued down below that lower band, but didn't quite stretch far enough to trigger those exits. So that's kind of a nifty little customization to this tool that some traders might employ. But what I want to do now is let's apply this to a more current example and get a trade entered. So I'm going to come up here. Let's just clean this up for a minute. And I want to have a look at what's going on with Netflix. And Netflix has had a couple of very recent reversal points. So I'm going to do this. I'm going to use a combination of these. Let's add a second anchored VWAP. Add that to our chart. And this one, apply 2 to our chart. I'm going to anchor 1 here, right click, set the date of the first one to this reversal. I'm going to right click, set the date of the second one to that one. And what I noted with this is the first one has recently come down, bounced off our VWAP line. Our shorter term one, since that more recent reversal, has just broken through. So an entry might be entering on the evidence of the sort of intermediate evidence of the bounce off this VWAP, the more precise evidence of the breakthrough, that recent one. Journey, you like that one? Is that worth the price of admission? Very good. Let's go place our trade. I'm going to leave that on the chart, but where would we place our stops? Probably half of a, not a percentage, half of a standard deviation below. In any case, let's go place our trade, and I'm just going to do the long side of the entry side of the trade for now, just in the interest of time. Let's buy, 100 shares. Let's make it about. Let's see. Do I want to do $6,900? Yeah, that's okay. $6,960, around $7,000 trade. Let's confirm and send. Is this the right stock? No. Make sure it's the right stock. We're looking at Netflix. Click. It's a $1,200 stock. 10 shares. We'll take that down to 5. Be consistent-ish with that investment amount that we just discussed. Let's click confirm and send. Buying shares of Netflix. Buying 5 shares of Netflix. About $6,200 investment. Not a commission on this trade, but on that breakthrough of the recent VWAP since that most recent reversal. So let's send that off, and we are in. Okay. So our plan is I'll go in after the webcast is over and add a stop that's going to be a half of a standard deviation below that shorter term VWAP. But guys, we've accomplished what we set out to do today. We talked about how that anchored VWAP is built, how it might be used. We've even customized it for exit strategies and also discussed where the anchor points might be adjusted. Hope you enjoyed this discussion. This is what we do on Fridays. If you like these sorts of discussions of charting, make sure that you're joining us each Friday. Now, I'm going to let you go enjoy the rest of the educational offerings and your weekend. But just remember, If you haven't subscribed to the channel yet, do that. It's a great resource. It's where we post our concluded webcasts. You can find those on the playlist. Also, make sure that you're following Mike and me on X. You can find Mike on X at Mike Fairborn CS. You can find me on X at Cameron May CS. You want to see that? There's that handle at Cameron May CS. There's the guy you're looking for. All right, everybody, go have a great rest of your Friday. Enjoy your weekend. Thanks for all the thumbs up. I can see 172 people watching and 61 have already clicked that thumbs up. That's always appreciated. Mike, thanks for helping out in chat. I will look for all of you in a future webcast. I'll also look for on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.